Thanks for your interest in our company. Tim and I are going to be bouncing back and forth in the presentation a little bit, telling you about NN and our strategy. So with that, just spend a minute taking a look at our forward statement. We'll be providing information on the company as well as some of our outlooks, so I want to present that. A little bit about NN. Revenue-wise, we're about $424 million on an LTM basis through third quarter. Our adjusted EBITDA through that period was also about $48 million. We do have a very large JV in China, so they've got a revenue that we don't consolidate of $130 million. We're about 2,600 employees and approximately 700 customers. Our key end markets are in the electrical and grid distribution space, defense and electronics, and obviously our large China automotive presence. Other, lesser markets were in North American auto, EMEA, some commercial vehicle and industrial and medical as well. So Tim,
24 facilities on 4 continents, 2,600 employees. That doesn't include the JV that Chris mentioned. The large concentration of the business is in the U.S., 65% of the volume, followed by China at 15%, and then Europe and South America at about 10% each. We're set up really well to service our customers globally on a local-for-local basis because we have in-region assets, and we're almost what would be considered an anti-tariff or a tariff beater operation because we don't import a lot and we don't export a lot. It's usually local for local in how we supply.
So our investment thesis, about 8 quarters ago, we underwent a transformation exercise. It's on track. We started with transforming the revenue and the cost profile. That was started about 6 quarters ago. So the focus of this transformation is really getting the revenue and cost profile in a low cost, higher growth mode for revenue. We want to reposition our business in the legacy markets. So legacy meaning the automotive markets in China, North America, as well as our stamping business. And then get ready for ramping up our new business wins. We put a consolidated effort into our pipeline in the last couple of quarters to try to improve and grow our revenue. And Tim will be talking a lot more about that in the coming slides. Our long-term targets that we put out just a few quarters ago to try to achieve $600 million in revenue by 2029, adjusted EBITDA margins of 13 to 14%, gross margins around 18 to 20, and obviously optimizing our balance sheet as part of that.
As Chris mentioned, our new business win program is driving growth while moving away from the lower margin U.S. automotive business. It's now only about 10% of our portfolio. We've made significant investments in both personnel and assets to focus on more historically higher margin markets such as electrical, A&D, as well as data center. And we're forecasting growth as we move forward. As you'll see in later slides, our start of production is in 26 should start to outpace our end of production. So we'll start to see some fairly significant top line growth as we move forward. When we first joined the company, we noticed that the pipeline had been largely ignored, that there wasn't a lot of new business wins coming in. And in our markets, from the time you get an award, it's anywhere from 6 to 18 months before you start to see revenue, and then that revenue starts to ramp up. So when you have that lull in the new business wins, you see that lull in coming years as the end of production outpaces the start of production. 2026 is going to be the inflection point of that, where we're going to start to see the growth on the top line. We're expecting, right now we're on a pace. We've won $65 million in new business wins over each year of the last 2 years. We're going to start to see a net growth of around $40 million on an annual basis, starting in 2026. The profile is also shifting, so we'll see that continued margin expansion as we go forward. We're intentionally shifting our sales mix. Our top 3 markets will remain the same: electric grid, defense and electronics, and auto in China. Commercial vehicle will see a higher push, as will industrial and other. And as I said, we'll be focusing more on medical as well as data center. To achieve this, we've upgraded our sales team. We've hired industry veterans in the markets that we're focusing on. Our core markets, again, are electrical, defense, general industrial, automotive, and medical. But having these industry veterans allows us to also now look at adjacent markets, which opens up our target area quite substantially. So you can see that electrical moves us into data centers, alternative energy. Defense also opens up into drones and laser optics, et cetera, and you can see that on there. So by shifting the commercial team into industry experts, we're opening up our target base. China is a big piece of NN's growth and current business. This is just our wholly owned assets in China. We have 2 wholly owned facilities in China. You can see that we've had steady growth, and it leverages the profitable and very large China automotive market. We're continuing to see that growth and expansion, and next week we'll be celebrating 20 years in our Wuxi facility. So it's been a significant portion of it, and again, it's a no tariff risk because it's largely local for local.
So just taking a look at our most recent financials, Q3, net sales were $103.9 million. We had quite a few launches in our Power Solutions business. So we have 2 segments, mobile and power. So did really well in Power Solutions. I mentioned we started our transformation about 2 years ago. It usually takes about 5 years for a company to really transform a business, and so we're still early in that transformation phase. In the past quarters, we've talked about a group of 7 plants that we've been trying to improve profitability. Tim and his team have worked that down to about 1 or 2 plants now, so we're about 80% through that transformation as far as the cost structure. So now it's really about revenue kicking in. The adjusted EBITDA in the third quarter was $12.4 million. We hit an 11.9% margin on that, so getting closer to our target of 13 to 14%. Our adjusted gross margin was 18.8%, so at the low end of that 18 to 20 that we're trying to get to. With these new business wins, and we achieved $11.3 million in the quarter, we expect that will help us drive those higher margins over time. Our adjusted operating income was $4 million for the quarter, about 3.9% of sales, and then we had free cash flow of $9.1 million in the quarter.
Again, the shift in market focus will drive further margin expansion, as Chris mentioned. With the exception of North American auto and commercial vehicle, the markets that we're focusing on are showing very robust growth and very solid going forward, typically higher margin. And that trend is continuing through the coming years. So we feel we're in a very good position with the enhanced commercial team and the focus markets that we've chosen. We've seen significant improvement in our gross margin as well as EBITDA margin through the rationalization of unprofitable business and facilities. We've also optimized our headcount. We've seen significant improvement through right sizing of our both direct and SG&A costs. And the mix shift in business is also helping to drive these profit enhancements. And we expect or are forecasting these to continue through 26 and beyond.
So with that, I think we expect that we're positioned for success with our transformation plan. So, taking advantage of our cyclical business and recovery in those markets, we're going to ramp up a lot of new business in the coming quarters. We started ramping up in the second half of this year. Our sales were a little bit flat in the third quarter because our existing markets were a little bit flat, so the new business didn't offset some of those, the rationalized business that we took out. So expect in 2026, assuming our markets come back, that we would see year-on-year sales growth. And then with the materially lower cost footprint, we expect significant leverage to our bottom line. So that's how we are looking toward getting those margins up into that 18 to 20% at the gross margin level and 13 to 14 on the adjusted EBITDA percentage. So obviously we're committed to value creation, both companies, shareholders, employees. This transformation will help deliver those results, and we're prioritizing shareholder value with the transformation. And we expect the value unlock will be through the balance sheet as well. So we've got a recap process underway as well that we're looking at the balance sheet along with optimizing the cost structure. So with that, we'll turn it over for questions.
Well, I'll start it off. We talked a lot about margins. You recently provided a mid-quarter update where you indicated adjusted EBITDA and gross margins in the fourth quarter could hit the 14 and 20% goals that you had, so you're well ahead of plan. And you had another slide in there mentioning that some of the new business coming in was coming in at 27% gross margin. So How much more upside do you think could be in those margins as the mix shift continues?
Because the markets that we're focusing on are inherently higher margin than let's say the lower cost, the commodity side of the U.S. automotive business, as we migrate away from that, we'll continue to see this margin spread. This is combined with this is combined with the continuous improvement programs we have on there. So we're expecting to see that upward trajectory of the gross margins to continue for a significant period of time.
It's dependent upon the mix of revenue as well.
Right.
I mean, if the North American auto space comes back a little stronger, that's, got a little lower margin impact. So it's dilutive to compare to the new business. So it might, that getting to that 13-14% adjusted EBITDA might be a little bit delayed. But if the new business ramps up even faster, that would get us toward those longer term targets obviously faster.
Exactly.
Yep. Yep.
Thanks for the presentation. I know you guys sold a factory last year, $17 million or so, I think. Any further rationalization, and what's the debt profile, and what's your plan for managing the debt?
Okay, yeah, a lot of good questions there. So, yeah, we have no plans at this point that we've announced about, further rationalizations. We do have one plant that still loses money. We're taking a look at that very hard. We sold the Lubbock plant last year that was in the plastic space. So I think Tim can talk further, but we're definitely looking at, all of our business. We continue to look at the business, try to make sure it's all making money. But, you 80/20 that, and you try to take out a little bit as you go. We don't want to take out too much because we've got a cost structure to maintain while we ramp up that new business. I don't know, anything you want to add?
Yeah, I think when you look at the plant we sold last year in Lubbock, it was plastic, and for anybody that's familiar with that industry, it was what I would consider to be a one-off. It was a non-core asset. It was the only one that dealt with polyethylene or plastic, high-density polyethylene, and without an economy of scale in there, it's very hard to be competitive, so you either have to grow. So it was a logical choice for us to exit that. As far as the facilities that we're looking at now, there's one or two that we're looking at very closely to continue. From the group of 7, we're down to group of 2. But as Chris said, there's no definitive plan at this point.
Yeah, and we're moving as fast as our cash flow and liquidity and debt costs or debt structure will allow. So we're pretty constrained there. It's a capital structure that was put in place about 4 or 5 years ago. We refinanced that cap structure in it was December on the ABL and April in the term loan. Obviously, it's not optimal for us. The term loan's pretty highly priced, but they're supportive. We're happy we're in the term loan, and then we've got the pref that we're looking at as well. So I think overall, we've still got some optimization work to do on the balance sheet. I think if you step back and you look at the numbers, there's been a lot of good optimization in the cost structure. The revenue's starting to kind of take off. So we brought in some new sales folks on the commercial side. So the pipeline's doing well, the new business is doing well. We've got to get that flowed through the P&L. And then obviously the balance sheet, we need a balance sheet that will work for the business. Yeah. Good questions, thank you.
I'll let you with another one. So one of the things that you guys have talked about in the past is potential M&A. What would be the kind of the areas that you would focus on any potential M&A transactions, and how do you think you could go about financing the M&A type of transactions?
Yeah. Well, fortunately, there's a lot of activity in our space. So in the precision manufacturing and stamping, there's just a lot of companies out there, and there's a lot of deal flow that we're seeing. And it's really we get an inbound, I don't know, every other week or so. It was every week for a while. For us, it's really about, is there synergy play there? The capital structure is pretty constraining, but fortunately, we're seeing a lot of potential out there. We're very happy about that, and we're gonna, at the right time, we'll try to figure something out with the financing of it. But I think there's a couple of logical things out there that we're looking at. We haven't obviously made any commitments at this point. We'll 8K those as we need to, right? But we're very happy with what we're seeing, and we've been in discussions for a long time with a few folks and just trying to figure out, does it make sense financially? Commercially, there's a couple that make sense. So we're active, but obviously we're a little bit constrained with the balance sheet. Yeah.
So one of the markets that you went into, you know, a lot of fanfare was the medical market. And obviously part of that was the legacy history of the company,
Yep.
having built up a big medical business, which you then sold off. How are the efforts today going on the medical side, and kind of where do you see them moving here in the next couple of years or two?
The traction in medical has been slower than what we anticipated, but we are starting to see that pick up. We have made some changes within the commercial side of that to enhance our efforts there. We have made significant capital investments in technology that works for those, the specific lathes and milling machines that really work in those markets. So we are starting to see the traction take place. The pipeline is growing quite significantly right now, and we're expecting to see some very strong results in medical in 26.
Yeah, we've got quite a few plants that are ready to produce, right? And
Right,
are producing.
we're 13485, which is the medical certification in 4 facilities today. We have one that's FDA, and we're in the process of getting 13485 in 2 other facilities. So we're creating a very diverse footprint that's going to allow us to supply into that market, and that combined with the commercial effort that's really picking up pace, we're still anticipating strong results for that.
Yeah. And we've got new equipment in place.
New
right?
equipment in place,
Yep.
we made capital investment. Yep.
Yep.
And relatedly, a newer market, at least that you've identified, is the defense market.
Right.
Maybe you can tell us some of your efforts that you're doing there, and where do you see that market going to?
We're working a lot in A&D within our plating division. We're doing a lot of selective plating and precious metal plating for control systems within the A&D space. That market seems to be taking a very strong uptick this year. And that combined with some machining aspects, we're seeing it as well. So right now, the big growth area for A&D for us is in that plating side of things, but it is expanding into the more of the machining and stamping side of it as well.
And can we talk a little bit more on the tariffs? You know, I think as people sit here and say, how can these not be being impacted by tariffs? You know, one would be, you know, the primary, and the second would be the secondary kind of impacts of, you know, tariffs. People, they drive up the price of cars, you know, how does that impact you guys? And maybe you just talk a little bit more about tariffs.
As a manufacturing organization, we're largely tariff adverse, meaning that we don't import a lot of raw material and we don't export a lot of product. So we're largely local for local from a manufacturing base. Demand, though, is impacted by tariffs. So we can see, and I think some of that is the softness we're seeing in the automotive market in North America right now, is that prices are being driven up. We are getting a lot of inquiries for what I would call as onshoring of business that was traditionally imported into the U.S. We are getting a lot of inquiries. Only a couple of smaller opportunities have pulled the trigger, per se, to move it to domestic, because there's a whole approval process for those of you that know automotive and some of the other markets we're in. But that's really, the impact is more from a demand standpoint on our base markets today. But we also see that starting to move as more and more people are looking at onshoring.
Yeah, yeah, because we're, as Tim mentioned, we're pretty much making in-country and selling in-country, whether it's China, North America, Europe. A little bit of exposure on the raw materials, but relatively minor in the grand scheme of things. But the demand piece is really where we
feel the pain.
Yeah, you know, North American auto, as that demand's, you know, been lower, that's where we feel it primarily, just overall demand.
And I think that's part of as people get adapted to the tariffs, they're looking at that opportunity to onshore. So we're feeling it from a demand suppression a little bit. I think we're seeing the markets in North America be a little bit down, and in some of the areas we're seeing electrical grid being a little softer. We're seeing U.S. automotive a little softer. But once we get through that trough and people do that onshoring, we should see that demand pick up, where typically product that was imported is now being made domestically.
I got one more for you.
Sure.
So obviously the China market has been doing very well for you guys. Maybe you could talk a little bit more about what's driving the performance there, and kind of where do you see that business over the next, you know, 4 or 5 years growing to?
With the growth, with the slide that we showed, you can see that we've experienced significant growth in China. It's basically serving the China automotive market, which is very robust, very large, and profitable. And what we are manufacturing, what I would call mission critical or safety critical components. They're steering pinions, braking components, those types of things that are critical safety aspects. So they're a higher, I don't want to say a higher quality, but there's a higher tolerance required for those parts. So because of the growth that China's experiencing in that automotive market, we're expecting to see that growth continue, both in the wholly owned and in the JV, to be honest with you.
Yeah, we're selling in market, but our customers,
They may be exporting.
they're exporting, yeah.
So as China starts to export into Europe, we're selling domestically, but they're exporting more globally. So as that market continues to grow, we should be able to continue to expand our share.
With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple, then Channel Check truly is your tree. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series luncheons, and to be part of the preeminent annual Small and Microcap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.